Today I'm going to be going over my trading strategy that allowed me to turn $500 into over $64,000. Now before we get into this video, make sure you check out the description and join the free Discord trading community where you can level up your trading with other like-minded traders. Getting right into it, straight raw strategy. I'm going to be going over exactly what I do day to day so I can bottom and top tick the market, get absolute killer entries. So first things first, you want to go ahead and start on the higher time frame. This is essential work. So we can see where right now price has swept these highs. Why are these highs important? Now in this current part of the replay, these are all-time highs, right? So these are extremely strong draws on liquidity. Price is inversing these gaps and we're showing bullish momentum. We're at least going to manipulate above these highs. So you definitely want to be cautious of trying to short near all-time highs. So now that we have our high time frame liquidity drawn out, we see that we are starting to break bullish momentum above here. We drop down into the next time frame, the 4 hour. So here on the 4 hour, we can see a few interesting things, right? What I like to do on the 4 hour is to mark out any significant draws on liquidity. Besides draw liquidity, I'm also drawing out these PD arrays because these PD arrays hold a lot of potential to move price or reverse or react off of. The first thing I notice here is we have this huge 4 hour rejection block. We also are currently inside this 4 hour fair value gap. But the thing that's so special about this 4 hour rejection is that we have this gap down here. So it's making me believe that we're definitely going to be touching at least down here. And we have a devil's mark. If you don't know what a devil's mark is, that's basically when a candle does not have a wick. And the reason that's so important is because when you have a devil's mark, price more times than not is going to come back to create that wick. It's not going to leave it bald forever. It's gonna give it its haircut, right? It's gonna give it a little bit of hair. But this bald guy, he's got to get knocked out real quick. Got to give him a little slap on the head. That's why devil's marks are so important. Strong draw on liquidity. Now that we have this fair value gap and this devil's mark down here and this rejection wick, I start to narrow down my PD arrays. This 4 hour gap, I'm going to keep it in mind, but I'm also keeping this wick in mind. It might not hit today. It might hit in a few days. Who knows? But that's definitely a strong draw on liquidity. We go down into lower time frames. So the 1 hour, we can start to see some interesting stuff. In this 4 hour fair value gap, we also have a BPR down here. We also have this fair value gap right here. And we're currently rejecting off of this fair value gap up here. Now, what you have to keep in mind is that you're not trading at whatever time. You're trading at specific times. And that's what's going to give you the edge, the true edge in the market, trading at these specific times along with the banks. If you trade when there's bank traders involved and you can follow their moves, you're going to be seeing a lot higher return on investment. You got to think like the bank trader. You can't think like the retail trader. So now that I have all these PD arrays in mind, what I'm going to do is I'm going to continue down. So what we see during Asia is that we shoot up. We're absolutely ripping through these highs. Then we start to lose momentum during London. During London, we start to accumulate. We're not going up. We're not going down. We're just staying in this zone. Now, why is that important to note is because usually market moves in 3 main phases. This is referring to the power of 3. Within the power of 3, you have accumulation, manipulation, distribution. And here we have a perfect example, right? So we have an accumulation here. We're not going above these highs. We're not going below these lows. We're just accumulating. And then what happens? We manipulate down and we distribute up. And that's what left behind the 4 hour rejection block. Wicks are so important, guys. I can't stress this enough. Wicks are your best friend, only if you can choose them correctly. Now, this is why it's so important to start from the higher time frames to the lower. What we can see within this 4 hour rejection block right near the CE is that we have this devil's mark on the 30-minute. Just like I said, you might find it funny, but it's serious. In the markets, statistically speaking, more times than not, a candle without a wick is gonna come back to create that wick. If you can identify those wickless candles, they can definitely work to your advantage if you can spot them and implement them into your draw on liquidity. So keep that in your mind. The bald guys gotta grow some hair. Like 99% of the time, they're gonna grow some hair. So keep an eye out. Now, do keep in mind, this goes a lot stronger for higher time frame candles. If you're on the 1 minute, you could probably see some wickless bodies. But if you're on the 1 hour, 30-minute, 5-minute, 15, they could definitely create strong draws on liquidity. But your strongest ones are going to be on the 30-minute, 1 hour, 4 hour, and especially daily. So now that we're familiar with the accumulation, manipulation, distribution, the power of 3, we can now move on to the next cycle. We accumulated, manipulated down, distributed up. Most likely, we're going to come back down within this distribution to then continue. What we could be seeing right now is an accumulation, and it manipulates down into this previous distribution to then create a further distribution up. Now, this is so important in trading. If you can understand this, you can upgrade really any strategy. If you can understand the power of 3 and AMDX, this is just so special, guys. I can't stress this enough. This is your bread and butter. So that's what we're expecting now. The manipulation down, since we're accumulating, manipulate down within these PD arrays to then see a further distribution up. Narrowing down which PD arrays we want to choose, we continue to further narrow down our PD arrays. We hop on the 15-minute, and here we can see we are in pre-market. It is 7:45. Let's go ahead and push this to 8:30. One thing I'm also going to do on this 4-hour rejection block is I'm going to set up my OTE. Now, if you guys don't know, OTE is the optimal trade entry. This is a killer tool. This is what the banks use to get their precise entries. Basically, just maximize your RR. If you are going to catch the move up, not maximize your return on investment by catching the lowest point possible. You're minimizing your risk by a lot, and you're also increasing your return on investment. Now, usually around to 8:30 is when I start to mark out my standard deviations, because what I like to mark out standard deviations of the sessions. So with this indicator that I use, it already marks out the standard deviations for the Asia session, but I usually find that marking out London sessions low to high a lot better. And off the rip, we can already see we have a standard deviation lining up basically right on the dot with this 50% mark of the rejection block. We have the devil's mark there on the 15-minute, the 30-minute, probably on the 5-minute as well. We have the 50% mark of this rejection block. We have the negative 3.5 standard deviation from the London high to low. We also go ahead and mark out last leg of London, which is also the first manipulation that we have after London as well, which is also a good standard deviation level to have. And here we can see that some levels are lining up a bit. And then we want to also mark out the last manipulation leg before New York AM session. So playing this, we're going to go ahead and start the day. We're going to go down to the 5-minute. And we can see here right at 9:30, we are manipulating down. We're manipulating down, down, down. And we can start to see where off this last manipulation leg that we had before New York Open, we are reacting off of that. Now, another standard deviation that is pretty important to use is the manipulation leg right before, during, or after the 9:30 manipulation. Okay, so this is where patience comes in. We need to sit and analyze our standard deviations and choose the appropriate levels. You could say, wow, you have all of these standard deviations lining up. Why is it low probability? You have the negative ones here, right? You have negative 2.5 here, negative 2.5 here, but you have the negative 1 here. The negative 1 is not a reversal zone. This is an accumulation zone. So it could accumulate and then continue up, or accumulate and then go back down. The 1 to 1.5 is your reaccumulation zone. Typically, you don't want to trade within this. The next areas that we're looking at past these 1.5s, these 3.5s here. What's the nearest thing on this 3.5 is the CE of this fair value gap. And within this CE of this higher time frame fair value gap, we can see that we have these smaller time frame fair value gaps as well. Now we just need to narrow down our entry zone. And you may be asking, okay, how do you know that we're going to reject off of this area up here and not down here? The reason is because we have a lot more standard deviation levels lining up here in this general area than we do here. What we have to keep in mind as well is that this is a huge range. These large ranges with multiple PD arrays, we usually like to create liquidity. What does that mean? It's very likely that we can react off of this higher PD array, leaving back some liquidity for another day. So when we do go back down to this rejection wick, we also wipe out liquidity, making it an even better trade setup for a future date. So we have to think like the banks, right? What you could do here, you could take this level in itself. This right here, pretty killer. You have multiple standard deviations, 3 standard deviations lining up near perfectly. If you wanted to put your long limit down here, you would be fine. And some secret sauce, if you have these standard deviations and you also check the book map behind it, you can check where the resting orders are. It'll literally show you a huge red line or huge red bubble, however you have it, or green, blue, whatever colors you have set up. If you have book map or footprints, you can basically see the resting orders. That's another confluence you could add to figure out whether your setup is an A+ setup or not. Now, looking further into these -4 deviations that we have lining up, if we go into the 4 hour, we can also see that these -4s line up near perfectly with the 0.5 of this 1 hour gap that's also within this 4 hour gap, setting up for a beautiful trade opportunity. So we keep that in mind. We didn't take these up here because we're still within the 1 to 1.5 in some of these standard deviations, but these down here are a lot higher probability because they're lining up perfectly and we're not within a 1 to 1.5 zone. We have standard deviation, OTE, high time frame PD array, clear draw on liquidity. We're breaking all-time highs, so we continue with that momentum. Trying to short all-time highs is like trying to catch a knife. So with all these levels in mind, this is probably going to be the area that we're looking to reject off of. Now, whether you want to put a limit here or if you want to wait for a rejection off of it, it's up to you. If you're going to put limits here, 10-point stop loss, $200 risk. And if you're going to be going off of these limit orders, you typically only want to have 2 to 3 levels maximum. Not that you're going to take, that you're looking at. Risk management is key, guys. You have to make sure that you manage your risk because you can't just be blowing all your money away. The less time you spend trading is the less time you spend risking. The less time you spend risking is going to preserve your capital and is going to let you expand that capital. We have to keep this in mind, guys. Risk management is key. So let's say we go ahead and put our limit down here and we're going to see how it plays out. And the cool thing is that if you notice here, the true day open is right on that liquidity that we swept we had marked out. So that is going to be a strong target for your take profit. Your first take profit should be whatever high that we have created. Let's say we dump down here and we get tapped in. Your first TP would typically be this high. Your second TP, the true day open. Your final TP would be these highs over here. So you have to be very strict with your TPs. You can't just get into a trade, let it run, and then expect it to go forever. Because it could easily just come right back down, smack you out of it. And if you don't even have a stop loss set, or if you started messing with your stop loss, you could now even be in loss. Like you could have been up 50,000 bucks, but just because you were too greedy, you went ahead and messing with your stop loss. You kept holding on to your trade, wanting more and more instead of waiting for a new setup, a new day. You lost it all. Don't be greedy, guys. If you want to build wealth, it takes time. You can't just do it in one day. If you want to be lazy after you're rich, by all means do that. But if you want to get rich in the first place, you got to be consistent. You got to stick to your plan. You can't switch up on yourself. How are you going to expect to be successful if you keep stabbing yourself in the back? If you keep switching up on yourself, you have to have your own back. There's nobody that's going to hold your hand and guide you when you are the only one that makes the choices and that can make the choices in your life. You are the only person responsible. Now we go ahead and press play. Now keep in mind, most of the time you can just have this on the background. You don't want to be glued to your charts all day, right? If we start to consolidate here, you can just set an alarm, a limit for when we get into it. You can see we get tapped right into it and we just absolutely start ripping up. This is crazy. Without even having to look at the chart, honestly, if you're using proper risk management, you have these 2 to 3 levels marked out and you choose 1 or 2 of them and you set your limits there. You don't even have to look at the market. You set your limit order, you set your stop loss, you set your TP, and this can all be done without even looking at it. And that's honestly what I recommend once you're in a trade. If you get into a trade like this, as soon as you get up 10 to 15 points, go ahead, put that stop loss to break even. If you bottom tick an entry like this and price starts to go down near to your entry, more times than not, is going to knock you out and it's going to continue going the opposite direction. Keep that in mind. Break even is your best friend. Always, always, always go break even after 10 to 15 points. There's no reason for price to reverse back to your entry if it's an actual reversal. And now the results speak for itself. With a risk of $200 on one NQ contract, we would have made $2,655 on the day on just one account, one contract. That's a 13 risk to reward ratio, meaning that for the $200 you risked, you made 13.28 times the amount that you risked. So we have to keep this in mind. What did you learn so far? First things first, higher time frame. What do? You mark out the high time frame draw on liquidity, high time frame PD arrays, and then we continue down and see what lines up with the higher time frame PD arrays and draws on liquidity. The higher time frame rules over anything. You then continue down lower time frames. You start on the 1 hour, mark out any PD arrays, draws on liquidity, same thing on the lower time frames until you get to the 15 to 5 minute. That's when I start to draw out my standard deviations, and specifically the standard deviations that I mentioned, not just any manipulation leg or any leg in general. It's these very specific legs that other institutional traders are also marking out. They're also looking at these levels as well, and those are the people that are going to move the market thousands of times more than we can. Even if you're trading NASDAQ with $10 million, you won't move the price of the NASDAQ, not even a fraction of what the banks can do. And now the way that you can compound this easily with prop firms, buy a $100 account with Top Step or something like that, take Profit Trader, and then you pass the account. You could leverage your $100 way easier with the $50,000 funded account. You start copy trading them with 5 accounts, and the leverage is absolutely insane. This is the opportunity people don't understand about prop firms. We have an insane ability right now to be able to leverage our money in an insane amount. So there we have it. Those are the fundamentals basically. So we have AMD, standard deviation, high time frame draw on liquidities, and PD arrays, and then along with price action is going to give you perfection in trading. The only thing that's going to make or break you is yourself and your psychology from here on out. You know the strategy. If you could be patient, sit on your hands, not get into every move up and down, wait for your levels to get tapped in or not, that's when you're going to see progress. You don't have to chase the move up. Let's say you didn't even get tagged into this position. Don't chase it. Why would you chase it? If it edges this level, more times than not, it's probably going to go ahead and just dump right back down because it edged the level. You want to keep these things in mind. This is the beauty of trading as well. Right here, we can see where we reacted right off this 50% mark as well. So without even using standard deviations, if you just have a basic understanding of price action and PO3, then you literally could just be profitable with that in itself. Patiently wait for your entry, no matter your trading style, and you will see results. You overtrade, no matter your trading style, you're gonna fail. So I hope you guys learned something in this video. There's also other things such as SMTs, which are very important as well. I'm gonna be going over that in a different video. There's also a lot more confluences, guys, that I do use in my trading strategy, but these are just some fundamentals. It's just a lot of things that you drill into your brain over the years of trading that it's just secondhand to you. And it takes time to build these confluences into your mind, so you just subconsciously recognize them, and without even a second thought, it's like riding a bike. So make sure you check out the link in bio, join the free Discord community. I definitely want to see you there. I want to see you succeed. If you made it to this part of the video, I believe in you. If you watched this entire video already and you sat through me yapping and you actually learned something here, you are the type of person that I want in my group. So don't be afraid, don't be shy. Come join, say hi, ask any questions you might have, and I can't wait to see you there. Good luck trading, guys.